I'm Chris Loeffler, CEO and co-founder of Caliber. We are an alternative asset management firm that creates strategic investments to build generational wealth for our investors, the communities we invest in, and our team. That's what we've been doing successfully for nearly 15 years. As an alternative asset manager, Caliber has strategies in real estate and credit. But what truly differentiates us is our focus on the middle market and the vertically integrated services platform we've created to service that market. Today, we have more than $2.5 billion in assets under management and under development. And over the past 5 years, we've grown our capital formation at an annual rate of 30% and our assets under management by 25% per year. We have a tremendous cycle-tested team with deep industry experience, track record of growth, and a history of delivering solid returns to our investors.
Hello and welcome to the Share Series Monday Management Update. I'm Tamara Gonzalez and I have the pleasure of speaking with Chris Loeffler, CEO and co-founder of Caliber. As a reminder, please hit the question button at the top of your video player to submit questions. We will take those at the end of today's remarks. Well, to begin, Chris, would you like to start by providing us with an overview of Caliber and its business model?
Love to, and thank you, Tamara. Looking forward to the conversation. So Caliber is in the business of investing in, managing and developing real estate, specifically what we think is undervalued real estate in markets that we know really well. The company's a 15-year-old business headquartered in Scottsdale, Arizona, and we essentially run our business with what we think is a proven business model as an alternative asset manager. I'm going to get more into the detail of what that means as we go through the conversation. Caliber's got $2.9 billion in assets under management and assets under development, which is essentially how we measure the size of the markets that we operate in and the value of our various funds that we manage. And over the last 5 years or so, Caliber's grown at an annual rate in assets under management by 20% or more. We completed our IPO in May this year, and recently got public under the ticker symbol CWD. And I think what I would leave you with, just starting from the beginning of the conversation, is that this is like I said, a 15-year-old business with a time-tested team. The company has been proven through the market for a long time. And we're coming to the table really for the first time in the public markets, but we're a pretty well-known commodity here in Scottsdale, Arizona.
Well, Chris, why did you choose now? Why did you choose this time to go public in this market?
I think our public offering was strategic in nature. And of course, every company that goes public is trying to increase access to capital, flexibility to financing, and sort of the ability to grow through acquisition and other types of activities. That's normal. But I think if you go a little bit deeper in Caliber's intention on being a public company, there's a couple things I would want to point you to. One is Caliber's been public reporting since 2020. Our financials have been publicly available since 2017, in essence. And so the step to get listed for us was a final step in a long journey. And that step was to provide transparency to the market participants who buy our funds and our underlying investments. And so because we're in the business of creating different investment funds and strategies, raising capital for those funds and strategies, there's a significant benefit for the sponsor of those funds to be public in the eyes of the investors who ultimately put millions and hopefully hundreds of millions of dollars into our different funds and strategies. So there's gaining access to capital is not necessarily, in our case, simply raising money in the public markets vis-a-vis common stock. Mm-hmm. It may also mean raising capital into our funds and products, which specifically for Caliber is actually non-dilutive to the operating company or the public company.
And so you did a relatively small IPO. Do you have plans to do an additional raise in the future?
No, I think the benefit of us getting public, like I said, is to gain some of these ancillary benefits of being listed. We have an acquisitions platform, which we're very excited about. We have the ability to clear diligence for our customers in the wholesale channel to invest in our funds, which ultimately increases investment in our AUM. And we don't have any intention on creating dilution to our shareholders, especially at prices that are not attractive.
And so why is Caliber focused on alternative assets? What makes this attractive?
So I think first, let's define alternative assets. This is real estate investment, private lending, venture capital, private equity. Essentially, anything that's not traditional stocks and bonds and insurance products is considered to be an alternative asset. As an alternative investment manager, what we do is we create funds and investment strategies to invest in those types of assets. And we earn fees, profit sharing, and underlying income from managing those strategies. If you think about it kind of as a proxy to like a Charles Schwab, when you buy stock in Schwab, you don't own a specific investment in one of the funds that they've created, but you own the benefit of managing all those funds. And that's very similar to Caliber stock in terms of a business model. So why? At the end of the day, it's a fast growing market. We're taking a proven business model that's been very successful for other institutional alternative asset managers. We're taking a proven asset class in real estate and private lending, and we're applying it to a growing market, which in our minds is the middle market. This is a market that's gone from roughly $10 trillion in AUM across the globe in assets under management, expected to exceed $20 trillion in AUM in the next 5 years.
How do you get to $20 trillion?
It's demand. Investors are looking for something other than stocks and bonds in order to grow their wealth, reduce taxes, provide stability for their portfolio. And so whether it's a family office investor with $1 billion under management, or whether it's an accredited investor who has a $2 million net worth and is looking to put $200,000 into something other than stocks and bonds, the demand is exceedingly high. You see it with individual investors that are looking to gain access to alternative investments, and you see it with investment advisors who plan for those investors and are looking to gain access to alternative investments.
And how is Caliber, increasing access?
So if you look at the institutional market, let me define that for you. An institutional alternative investment fund would probably have between $1 billion and $20 billion invested. It's going to invest in institutionally sized assets, typically $100, $200, $300 million or more in size per asset. And it's going to be investing typically in institutionally acceptable markets. So that's going to be like New York, San Francisco, LA, right? Caliber is creating a fund size that is typically between 100 and 500 million, sometimes even sub $100 million in the fund size. The investment assets that we invest in are typically $5 to $50 million assets. And we're investing in places like Phoenix, Arizona, and Austin, Texas, or Denver, Colorado, places that are not necessarily in the primary market, but are in the fast growing secondary market.
And so by middle market, what size are these deals? How would you size them?
Yeah, so it's typically going to be a $25, $35 million project. We have to put up between 5 and 15 million in equity. The project is sometimes too large or too complicated to execute on by real estate entrepreneurs who you see all over the place talking about investing. But they might be either the projects themselves on an individual basis might be too small for an institution, or there might be too big of a turnaround required. And so Caliber plays an important role in that middle market by buying these assets, turning them around, essentially aggregating them, and then building them to an institutional quality and eventually selling them for a profit.
And so the products that you offer your clients, why would they come to Caliber? What's the driver for that?
Yeah, so investors, our customers at Caliber are investors. So as a shareholder in the company, you're an investor, of course, but also the company that you're buying is in the business of serving investors. What do those investors want? They typically want one of three things. They want income for retirement, they want growth on the value of their investment, or they want tax benefits. And usually it's a combination of those three things. And so Caliber creates a product that, for example, is an opportunity zone fund where you can avoid taxes, reduce your tax liability, and invest for growth in real estate developments, invest X dollars and hopefully increase that dollar amount down the road. We also have income products where you can lend your money and get a fixed rate of return. We have a Core Plus fund that allows you to buy real estate that's performing and producing a regular distribution. And so investors that are looking for different things are coming to Caliber and building trust with us once, and then investing hopefully year after year, decade after decade, and we hope generation after generation into different types of investments in real estate that fill the needs that they have as an investor at the moment in time that they invest.
And who are your primary customers or investors? Who would you say that, how would you describe that audience?
Yeah, it's not to overuse the term middle market, but it's a group of investors that meet the net worth requirements to be an accredited investor. So they have to have $1 million in net worth, or they have to have a couple $100,000 a year in annual income, all the way up to institutions such as family offices, large investment advisory complexes like multifamily offices, small institutions like local banks with wealth development groups or wealth management groups, as well as small pension funds. So there's a huge amount of that market that is somewhat underserved by the existing institutional alternative investment providers.
And Caliber has started investing in reaching out to that family office and wholesaling group. Can you talk a little bit about that and how that works?
Yeah, so for the majority of our 15-year history, we created a fundraising engine inside of Caliber. We were one of the first companies in the country to embrace public solicitation of a private security, which became legal in 2013. We started raising money directly from high net worth and ultra high net worth investors into our investment strategies and products. We did that by learning how to market to them, learning how to educate investors, how to build trust, and then having them invest directly with us into our products. I would equate that to selling your specialty product at the farmer's market. What we recently announced was that we've made a full investment into also bringing our products into the wholesale channel, which means instead of selling directly to that ultra high net worth individual, we're selling to their investment advisor. And that advisor might have 200, 300, 400 high net worth individuals as investors. They can due diligence Caliber once, they can decide to invest on behalf of their clients, and now they're investing on behalf of all of those existing customers. So it gives us more like taking our product from the farmer's market and bringing it into Whole Foods on the shelf. We're getting broader distribution. We're getting an advisor who's a partner to us, who understands alternative investments and can explain it to their client. And hopefully it's going to be a great channel for us.
Well, how does Caliber make money then? Can you walk us through the business model and how that works?
Yeah, so I mean, our business model, I think for a shareholder in our stock is incredibly attractive. Why? Well, first, we have multiple streams of income. So we generate income in asset management fees, which are annual streams of income that that we get off of a contract, an investment contract. So someone invests in our fund, and if it's a 10-year fund, then every year for 10 years, we're getting a fee for asset management underlying that asset. The second thing we get is performance fees. So if we execute on those investments really well, we get a share of profit from the investment, typically 20 to 30% of the profit over and above the minimum rate of return. And the third thing we get is the real estate services income from brokerage income. So every time we buy an asset or sell an asset, we're typically generating a fee. Every time we develop or construct an asset, we're typically generating a management fee for managing the development or the construction of that asset. And so we're hiring ourselves to do these services or charging at or below market rates. And all of those different streams of income all flow up to our shareholders at Caliber. So that's how we make money. The leading indicator for our business is how much capital are we raising? How is our AUM growing? And then you can do math to understand, as the AUM grows, what types of revenue are we going to generate and when?
So with your vertically integrated model, how typical is that model across traditional asset managers? I mean, do you operate the same, or is there something unique about Caliber's model?
So our model is typical for a smaller real estate developer. They'll often run this type of a model because it's necessary. A vertically integrated model is what makes it possible for you to do $25, $35 million deals at scale. Almost non-existent in the public markets. Larger public asset managers typically have shed all of these different services because they're focusing on institutional assets. They're managing 30, 40, 50 billion in assets, and they're only getting a small percentage of the revenue. So if you look at our AUM and you compare it to an institutional competitor, you're going to see that we generate a significantly higher level of revenue per dollar of AUM than most of our competitors.
And why wouldn't they have that same kind of model? What keeps them from doing the same thing?
Well, we're serving two different markets. We have some amazing aspirational competitors, companies like Blackstone, that have built themselves in the institutional market. There's no need for them to come that far down market to try to do $25 million deals. They're already being highly successful doing $250 million deals. Well, in a $250 million project, you can hire third-party service providers to do all the work, and you can just earn this very pure asset management fee for managing the investment. For a $25 million project, if you're going to make that project successful, a lot of that work needs to be done internally to keep control over the process. And so Caliber is almost required, based on the market that we're in, to have in-house services.
That makes a lot of sense.
Yeah.
So how would an investor think about valuing Caliber? How should an investor think about that?
Yeah, it's obviously, for a smaller public company, it's a pretty complicated business to understand. So I'm going to try to be as simple as possible. Caliber you can think about value based on revenue. So we produced a revenue run rate for asset management fees, which gives you an annualized view into what that revenue looks like. And if you look at other alternative asset management companies, they traded a pretty tight range of revenue in revenue forecasts as well as revenue growth. So that's one way to look at it, because as we grow our revenue in the asset management category, and as we grow our AUM, the other revenues that we get, and ultimately the earnings that come from them, from performance fees and transactional fees, tend to trail behind, okay? The second way you can think about it is a sum of the parts valuation. So you can say, what is just the asset management fee worth? What are the performance fees worth if we own, this large pool of assets and we sold them all? What would those performance fees be worth, and how much of that would we get back? And the third would be, what is the real estate services group worth if it was like a JLL or other real estate services group that's out there in the public? And so all those three parts come together to create our valuation. And in essence, hopefully that will help investors navigate how to value the company.
And what are your plans for growth? If we were to look 3 to 5 years from now, where does Caliber go from here?
Yeah, so I mean, that is the opportunity in Caliber. We're a growth-oriented company. Most of my public competitors are sort of on a stable path, growing at a couple percent per year and continuing to penetrate a market that they're already very well established in. Caliber is growing in the middle market sense, and we're growing as a growth-oriented company that we have a track record of growing for quite a while. So I would expect that, or investors can expect, that we will continue to pursue growth. We think that we are just barely scratching the surface in terms of what this market has to provide. And a way to think about that is we've built this business over 15 years with roughly 2,000 accredited households of investors. That's 2,000 out of approximately 13 million households in the US. And our investments aren't restricted to only US capital. We can actually take in capital from investors outside of the US. So we think that there's a tremendous market to grow in, where every investor in the country could get to a point where they say, okay, I've got my middle market real estate here with Caliber. I've got my institutional real estate here with some other company.
And recently you announced that you're building out a Caliber Hospitality Trust. How does that fit into your growth strategy?
Sure. So Caliber's been in the business for 15 years of creating private funds and private investments and managing those private investments. As those funds get bigger and bigger, one way to harvest those is to sell off the assets one by one in the market. Another way would be to do a portfolio sale where we sell off the whole portfolio and harvest a gain. And a third way would be to take that private group of assets and take it into a REIT structure and eventually take the REIT public and sell the assets vis-a-vis an IPO. The reason why a REIT structure is really attractive right now is because interest rates have gone up, the market has changed, and the REIT structure allows our underlying investors to get a tax-free exchange into a company that can attract capital and can attract growth. And so Caliber sponsored the Caliber Hospitality Trust. It's been something we've been working on for over a year and a half. And we're using the public company, the asset manager, plus the existence of the existing hotel portfolio we have to combine and create an UPREIT strategy for the market. We've got other investors. We've announced our first contributor who will put their portfolios into this company and hopefully grow it significantly and then eventually take it public.
So if you were to leave viewers with 3 points you'd like to make, what would those 3 points be about Caliber?
I think the first is the opportunity in the market. Okay. A market that's going to grow from 10 trillion to 20 trillion in AUM in 5 years needs access to more than just the same institutional product that's already out there. There needs to be broader and growing access to invest in smaller assets, because for every $250 million project in real estate, there's probably 100 or 1,000 or more than 1,000 $25 million projects to invest in. So one thing to just understand is you're investing in a company that's tapping into that market and knows how to do it well. The second thing is that we have a business that is designed for resiliency. So we have multiple streams of revenue that can give us multiple opportunities for earnings growth. And depending on what's going on in the market, we can lean into different types of revenue at different times. The third thing I would say is that you're coming into investing into our business right now at a pretty attractive valuation. And it's an attractive valuation because you're buying the public entity that benefits from all of these funds that we manage. And as we raise capital in these funds and we grow the AUM of the funds, we grow the tangible book value of the public entity. We're doing that without creating dilution to you as a shareholder. And so many investors that invest in small companies understand that they're taking tremendous risk, that if I invest in a small company, they just raise capital and continue to dilute my value. So even if their business grows, my share price isn't going to grow. Caliber's designed its business model in a way that the investors that invest in our public company as shareholders and co-owners with us benefit from the growth of AUM, of our underlying funds, and ultimately from us performing for our customers and producing profitable real estate investments for the customers that invest with us. So you're very well aligned with our customers. For Caliber's business to be successful, the customer has to be successful. The customer successful, you as a shareholder will benefit.
Thank you, Chris. That concludes, I think, our presentation. We are opening up the floor for questions. As a reminder, please use the button at the top to submit a question. Chris, we've got a question that just came in. With so many revenue sources for Caliber, how do you explain the disconnect between the stock valuation and the growth prospects of the company?
I think any CEO would tell you that if I had a magic wand to wave and match my value of my business to my share price, I would wave it in a heartbeat. I think the best explanation is we did a small public offering in a relatively bad market for IPOs. You can see in the history of our filings that we sized it down several times because we weren't happy with valuation. And so we didn't want to create dilution to our shareholders at the wrong price. Having said that, I would also point you to the fact that there must be strategic value for a smart company with real assets, real revenue, a track record of growth that's audited by Deloitte, that has built a tremendous base of assets into the billions of dollars to go public in a bad market. And so we saw a lot of strategic value in doing that. One of the first instances of that is the sponsorship of the Hospitality Trust. Have a public asset manager that creates an UPREIT, which will be one of the first roll-ups of hotels in the country. It's a decade. It is pretty attractive.
Okay. The next question is what's the insider ownership in Caliber? how can we think about that and relative to the share price again?
So I am one of the largest shareholders in the company. Myself, the co-founders, and the management team own about 55% of the company. We intend to continue to own a large portion of the company. It's not I know some smaller public companies have kind of a gun for hire CEO that only has a 1 or 2% of the company. That's not the situation here. And I love this business. I'll be here for a long time. So hopefully you come to like me too, and we can make some money together.
Okay, and our last question that we have here is how to think about earnings in the second half of the year and into 2024. And I know that you don't have guidance out there for the back half of the year or into 2024, but what could we share with viewers that might help them put that into perspective?
Yeah, so I'll point you to a couple of things. One is in our most recent earnings release, we put in a concept of an asset management revenue run rate, which is essentially taking the last month of asset management fees, annualizing it for you, and then comparing it to growth over the prior year. And while we're not putting out guidance, you can start to do math and you can start to see, okay, what's the trajectory of the revenue? Why is that important? Because as the asset management fees start to grow, what happens next is we're able to start producing transaction and advisory fees, and we're ultimately able to start selling those assets, hopefully for a profit and producing a performance fee. And so some of that revenue kind of tends to lag. Important thing to look to. The second thing you can look at is if you look back at our presentation when the company went public and the filings of that presentation, there's some seasonality to our business. The first quarter is the worst, the second quarter is the second worst, the third quarter is the third worst, and the fourth quarter is the best. So there is seasonality to our business, and I think that it's important to understand that seasonality if you're trying to evaluate our business. And then I will try to describe to you in very short sentence what we put out in front of investors in the second earnings release that we just produced was a very hopefully a very clear message that we have been investing in a growth strategy and continue to invest in that growth strategy. That doesn't necessarily mean for our business, we're not a tech company, so that doesn't mean we just lose money indefinitely and have to keep raising capital. It means that we see an opportunity in the market right now, which is interest rates went up a year ago. It's created major turmoil in the real estate markets. We're not a REIT, so we're not facing that turmoil in our underlying portfolio. We don't have to manage through that turmoil. Instead, we're an asset manager that's really good at buying distressed property. And so if we're ramping up, launching a bunch of new funds, raising capital for those new funds, we're preparing to take advantage of a downturn in the real estate market. And so as an investor in our stock, you're investing in a defensive play going after that downturn. You're not investing in a REIT, like an office REIT, that's going to be suffering through that downturn. There's a big difference between those two things. And so we're trying to tell you that we're investing for growth. Part of that is raising capital faster, launching new products, and preparing for what we think is coming.
Okay. And our last question, I believe here, what is the timing or the property acquisition that would trigger the IPO of the Caliber Hospitality Trust? So what are you thinking of in terms of timing for that public offering?
So I don't believe that REITs are successful with less than $1 billion in assets in a REIT. And so as a minimum hurdle in our minds, we've got to get to over $1 billion in assets in the REIT. Beyond that,
in the hospitality trust itself.
Yeah, in the trust.
Yes.
Which would accrue to our AUM. So if Caliber showed in our last earnings release, we're about $825 million in AUM. If you're adding in additional AUM in the trust, that's growing that number over time, and that's going to increase our AUM significantly. Why is that? Because the stocks don't perform very well. Small REITs don't perform very well. So it's better to stay private and continue to roll up assets than it is to take it public. Having said that, there's also a pretty attractive window in hospitality stocks that I believe is going to open up in 2024. And sometime between the middle to the end of 2024, maybe the beginning of 2025. It seems like a really strong window to take a hospitality company public. And so we're targeting, for that, watching that window, but we're not going to go there until the asset value is the size of the trust is worth taking it public.
Okay, well, great. Well, thank you, Chris. Thank you for joining us today, everyone. Up next on Share, we have Haverty's at 2 p.m. Eastern. So thank you, everyone.